Hi everyone. So today I wanted to speak about the debt component in the portfolio, and the reason I wanted to speak about this is because I see a lot of people including debt when they really should not be, or maybe do it a bit less. Especially if you have like a long time until your retirement, I think that is the time when you should maybe think about having a lower allocation to debt because the income that is coming in as part of your salary or job already acts like a debt component in your portfolio. So you need not invest too much in debt and you can have a higher allocation to equity. But when do you need debt? You need debt when your risk appetite is low, you cannot digest volatility, you have income needs, you want capital preservation, that is the time when you should have like more debt in your portfolio. And you can also follow a phase approach, which means that you increase the debt component as you are nearing to your retirement. Um, and in terms of sample allocation, which you can have or think about is like if you want to have a hyper aggressive portfolio, you can have like 0 to 5% debt and 95 to 100% equity. Then you have aggressive where you have like 10 to 20% debt and 80 to 90% equity, or a balanced approach wherein you have like 60-40 equity and debt, or a very conservative one where you have like 70 and 30, 70% in debt and 30% in equity. This graph basically shows that the over time as we age, right, the human capital starts going down and the financial capital increases, and the total wealth then accordingly increases as we age. Um, and this human capital, which can be in form of salary or active income that is coming in, because this is stable and for most people it's salary and income coming in from job, it can be treated as a um, debt component or fixed income component in the portfolio. So this is the reason why we should really if we have some time till retirement, why we should not increase allocation to debt too much. We do not need to have like 60-40 equity and debt because the human capital is sort of a proxy for debt component or fixed income component in the portfolio already. And finally, how do we include that component? You can have different approaches, but by and large, like broadly, you can use some of the funds which are available in the market, such as balanced advantage funds. Um, these funds, the fund manager can take a call how much, depending upon the market scenario, you can take a call of the allocation to debt, can reduce or increase the allocation to debt, and the range is quite wide. So 20% to 70% debt, and equity can go from 30 to 80%. This is a call taken by the fund manager of the balanced advantage fund. Then you can have investment through aggressive hybrid funds, which is basically higher allocation to equity, like 65 to 80% investment in equity and 20 to 35% in debt. And then conservative hybrid funds, which have like higher allocation to debt, 75 to 90% in debt and 10 to 25% in equity. These are different ways of hybrid funds and balanced advantage funds you can use if you are not very comfortable in choosing debt funds on your own. But if you feel confident about choosing debt funds, then you can look at different categories of debt funds which are there in the market, and there are many categories um, of debt funds which are there in the market, and this might confuse you also. But broadly, these are some of the popular categories which are there. So liquid funds, which invest in debt and money market securities with maturity up to 91 days. Then you have ultra short duration funds. These are funds which have duration of 3 to 6 months. Then long duration funds, which have duration of up to 7 years. Then you have dynamic bond funds where the fund manager basically takes a call depending upon the interest rate views he has. So he can invest in short term, medium term, long term, or these kind of funds. And then you have gilt funds which invest only in government security. So these are different ways of having debt component in your portfolio. But if you're not very comfortable in choosing debt funds on your own, then you can use any of the hybrid fund or all balanced advantage funds.